All right, start everything up. So first and foremost, as always, I appreciate every single one of you guys for coming and joining. Hope you guys had an awesome, lovely day. So for tonight's session, it's going to be a free-for-all. Any questions you have, anything you're curious about, anything you're struggling with, feel free to ask. We're also going to do some trade reviews. If you have any, feel free to put the trade reviews in, and we can help each other and see what we can do, because it's all about efficiency. We want to try to get our absolute best entries and absolute best exits, and the only way you're going to get that is by reviewing trades. First one we have is oil went nuts. Exxon was a fire call. Thank you, appreciate that. I'm hoping to be knowledgeable enough to plan out my own trades. Absolutely, I believe in you. It just comes with discipline and just consistency, but I believe in you. I need help understanding your analysis you give out. So Evan, what exactly are you confused over? Let me know what you're confused over, and we can go from there. How do you pick an entry based on theta? So that's actually a pretty good question. So if you're looking at an option contract and you are a day trader, ideally what you want to see is you want to see for the Greek values, you want to see your delta higher than your theta, right? This is important. So because if you see your theta higher than your delta, that's pretty much just a red flag that this isn't going to be the best contract. It's not the best bang for your buck. Sometimes even on weekly expirations, you'll see something like that, like on a weekly expiration, or even sometimes a 2-week expiration, you'll see your theta higher than your delta. And this is why it's important to be mindful of what you are purchasing, because if you see that type of stuff, that's just a red flag to not purchase that specific chain contract. Now, the only real stipulation, why this rule is not the case, is when options come closer to expiration. So if you notice, maybe 1 day to expiration or 0 days to expiration, 99.99% of the time, theta will always be higher than your delta, just because that's how the theta works. When the time decay exposure, the closer you are to expiration, the more and more severe the theta will decay you. So that is the only real justification and reason that it's okay to see a higher theta than your delta, is when you're close to expiration. But if you notice on a weekly contract that your theta is higher than your delta, this is not ideal. You do not want this. Now, let me take a step back. If you are an option buyer, which most of the people in here are, I'm assuming, option buying calls, buying puts, you do not want theta. That's not what you want. If you are an option seller, if you're writing the contracts, you're selling premium, you actually want theta. So it really depends on your specific strategy on if you want theta or if you do not want theta. Hope that helps. How and when to enter after a breakout? I love this answer. This is a good one. So here's actually a pretty good, let's do it from here. Here we go. So this is a trade that I took on Tuesday and we alerted. So let's just kind of paint the picture really quickly. Okay, price action came above pre-market high, rallied. We just rode up the VWAP the entire day. Everything is good to go. We created a nice little base of liquidity here. A lot of participants were kind of just inside right here, right? So then I was looking for puts because we kept making lower highs. We kept rejecting. The bulls were not stepping up. They just were not strong, right? So I was actually looking for puts right about here. Unfortunately, I missed the entry. And I was looking, ideally, I want to see a retest. This is the area that I wanted to see a retest, like this initial base right here, where participants were willing to step up. I wanted to see the price action kind of do something like that and retest it. Unfortunately, that did not happen. but we actually did get a retest. Remember, the stock market is not picture perfect. It's not going to give you a perfect scenario every single time. But this VWAP right here is acting as a resistance, right? You see that we actually rejected off the VWAP. Just even if it's not perfect, we rejected that area. And this is important. It doesn't have to be picture perfect. It doesn't have to be right on top of the VWAP. As long as it's very close, then that's fine. So in this case, it actually rejected off the VWAP. And I also missed this entry as well, but that's okay. But this is what I mean. You want to wait for some sort of retest, right? Because if you chase this type of stuff, the probability, I mean, in this case, yes, it worked out, but why would we chase this, right? After we just fell $1.50 very, very quickly, chasing into these lows, especially when we had a little bit of a base right here. So this is where participants were willing to step up prior. So you're kind of just, in this case, yes, it worked out, but not all the times that's going to happen. So just because it worked out once doesn't mean it's always going to work out. So this is why I don't chase into lows. Same thing, I don't chase into highs. I don't chase calls up here. I don't chase puts right here. I understand that, hey, I missed this trade. That's okay. There will be another opportunity. And if I see the price action come back at this area, which it always will, sooner or later, then I can enter puts. If you look here, it actually came right back to where I wanted to initially short at an hour later, right? So it will always come back, right? So that is the retest that we were talking about, the retest, and you can kind of see the follow through. But anyway, so going back and painting the picture, I ended up missing this entire downtrend. Yes, that's unfortunate, but I know that I'm not going to be chasing this. If I chase this, my risk reward is not in my favor. I'm overpaying, and I could easily get trapped out and then reversed on. So I was patient. I waited, and I'll show you the entry. I took a 2-minute entry. So I entered on the 2-minute, and I waited. And I saw, okay, because this is also something important. Most of the time, people see this type of stuff, like just straight falling off a cliff, and they try to buy the dip. Oh, I'm going to buy the dip. Basically, you're kind of getting in front of a tractor trailer, and you're going to get smashed, right? You're going to get demolished, because tell me in this picture where you see any bullish pressure. Like down here, there's no bullish pressure. Why would we buy this? Just because we hit 280, sure, that could possibly happen. We could get a bounce here. We didn't. So there's no bullish pressure. When I first started trading, my first like 6 months, this was my mentality. It's like, oh, well, we just dropped a lot. I could probably get a buy the dip scenario. And this was me being proactive, not reactive. So proactive means subconsciously, I wanted this to happen. Therefore, I actually entered prematurely. Reactive is this, actually waiting for more evidence. Okay, I saw we stalled out. The bears we failed to break below 279, a psychological whole number. I saw we had some sort of a V-shaped recovery, right? We broke through this downtrend, right? We broke out of it, and this is where I entered, right on this candle. And you can kind of see what happened, right? We had that relief rally that I was expecting. And if I was incorrect, that's fine. I would just cut underneath this low. That's perfectly fine. My risk is very capped, right? I'm not really risking very much. Whereas if I entered way down here on puts, technically speaking, my stop loss isn't until like way up here. This is like a 70-cent stop loss versus a 40-cent, 35, 40-cent stop loss. See, my risk is more capped. That's important. We always want to have the best risk and the best efficiency. So then look where we started rejecting it, right at this initial impulse down zone. This is the retest. There is a base right here of liquidity. So this is the previous base, and we got the retest. So the bottom side of this base is acting as resistance. The top side of this is acting as a support. So liquidity matters. You want to be aware of where large liquidity is sitting. This is why utilizing level 2s and times and sales is super important. So then also we want to be talking about traps. So we actually had 2 stop hunts right here. This is 2 stop hunts visually right here. So this is another thing that's super important. Most times people are technical analysis traders, which is fine, but they rely so heavily on trend lines. So if you were a strict technical analysis trader, you would have got stopped out here 100%, because most of the times people just say, oh, well, if it broke this, I'm out, right? But they fail to realize, look where we bounced both times. This is a previous base where participants were willing to step up prior. Look where they're willing to step up again, right? So trend lines are okay, but you don't want to just be relying on them in a sense, because you want to care about the liquidity. You want to know where the previous areas of liquidity are, where the overhead liquidity is, in this case right here, right where we came to, and this is where the previous lower liquidity is, right down here, right? And the psychological key numbers matter a lot. 280, 281, 282, 283, 285, 290, 300, etc., etc. They matter tremendously. So this is another thing that I used to do when I was a technical analysis trader only. When I would make my lines, I'd be like, oh, well, this area is at 280.16. In what world do you think a hedge fund is going to take the time to put in 280.16? No, they care about 280. They will define the 280 area. They don't give a shit about 280.16. Okay, what about 280.94? No, they care about 281, right? Look about psychological whole numbers and think about the liquidity. That is how the market moves, liquidity. And also stop run hunts. This is a stop run hunt. If it comes underneath your trend line, yes, you want to be aware of that, but you also want to be aware of where the previous area of liquidity is, where the previous area of base is. If it breaks underneath that, then yes, you are 1000% invalidated. But if it doesn't, you're still good to go. This is another reason why I don't like to enter up here. I don't like to enter up here, because yes, sometimes it works out, but other times it does not, right? So just because it works out once doesn't mean it's always going to work out. This is why I don't chase into highs and I don't chase into lows. Instead, I wait for retests. Now this in case didn't work out, but let's pretend it did. Let's pretend none of this happened. This is the retest. We came up. Yes, I missed this. That's fine. But once this actually holds and retests and becomes a new support, that is solidifying that this is now bullish. And then now my risk to reward is, if it comes underneath this, cool, I'm out, right? Whereas if you chase way up here, which most people do out of FOMO, it's like, holy shit, I'm going to miss this move. And you come way up here, look at your risk. Your risk is garbage. That is your risk. Almost 60 cents. This is my risk. 15 cents. You see the difference? Also, remember, your Vega is affected. Your volatility is going to be juiced. What happens when your volatility is juiced? You pay more money for your premium. You pay more money for your contracts, right? So that's not ideal. If you're not already inside this trade and you're coming late to the party, you are paying more money. Now, if you're only buying a couple contracts, that's okay. But you have to realize, when we talk about efficiency, right? When we talk about efficiency, what happens is, imagine if one contract, that's fine, right? That's okay. And you're overpaying by like $10, whatever, that's fine. Okay, that's fine. But imagine if you are overpaying with 10 contracts. You just overpaid $100. Imagine if you're paying with 100 contracts. You just overpaid $1,000. Do that 10 times a month. That adds up. That's a lot of money being pissed down the toilet because you have FOMO and you're chasing trades. You're not being efficient. Your risk rewards are skewed. Be disciplined and understand, yes, I missed this, but I understand in the back of my head, if this is indeed a true strong breakout, there will always be a retest and then another leg higher. always. The stocks don't just go straight up. You're not gonna, even if you miss this, yes, absolutely, you missed a little bit, but it's not just gonna keep going up, 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 up. No, it's gonna go back up, right? There's gonna be always a retest. Same thing. If you miss these lows, why the hell are you chasing down here? Like most people do. They come in and they're saying, oh shit, we already dropped $3. Time to go in. Like, why? Maybe you get one good tick, but like your risk reward is garbage. Why would you do this? Don't chase into lows, don't chase into highs. Hope that helps. All right, what else we have? Okay, how do you figure out if the buyers are stepping in? Volume. Looking at the liquidity and volume. Hope that helps. What is the purple line and what is the orange line? Yeah, good question. So my indicators that I like to use are the purple is the 200-day exponential moving average. The yellow / orange is 300-day exponential moving average. And then I use the VWAP, which is the white. I don't really use much else indicator wise besides volume, which is, if you're curious, because I know someone's going to ask, the one I use is buy, sell, volume totals for TradingView. And it shows whoever is in control. Like in this case, in this 2-minute time frame, clearly the bears are more in control because there's more red. In this time frame, the bulls are mostly in control. The bulls are definitely in control. So it kind of just helps you visually just see who's in control during that specific time frame. So Harold, I think you misunderstood what I meant. So the comment you said was that's not proactive by waiting for a few candles. Proactive is getting in prematurely. That is being proactive because you are biased. You're subconsciously, you want something, in this case, to bounce. That is being proactive. You're getting in prior. Whereas reactive is waiting for confirmation and waiting for more evidence. That is reactive. You're reacting to what is presented to you. Proactive is your subconscious bias telling you, hey, bud, I'm gonna, this is gonna bounce, get on in. When there's no evidence showing you that, like it's dropping off a cliff right now. That is being proactive if you enter prematurely. This is being reactive if you wait for evidence and thus reacting to the price action as presented. Evan said, when you say 282 QQQ next target for puts, is that the price it hits and then you do a lower strike price dated a few weeks out? Okay, so just to kind of clarify for people. All right, so let's pretend. Let's do it like something like this. So I'm assuming you're looking at like possibly like my newsletter analysis, I'm assuming. So let's just kind of make it easy. So let's just say if I say safe entry over 284. Okay, that is your initial target that you want to look for in order for that to hold. And if that holds, so let's pretend it does. So 284 pierces and holds for at least 2 minutes. It must hold for at least 2 minutes. If it only holds for a minute, you can get faked out. You want to see at least a 2-minute hold at a specific level. Okay, so then let's pretend it holds, everything's good to go. And then I would say targets. Let's say, for example, 284.50, 285, right? Just to make it easy. That would mean, okay, if this holds 284, these are your targets, 284.50, 285, so forth, right? And then these levels can play interchangeably. So let's pretend we are now at 286, right? So everything's been hit and all of our targets have hit, but we see a possible retracement. You just go back. Okay, this next target is 285. So then you just use this targets backwards. Okay, now my next target is 285 and then 284.50. So they're used interchangeably because all the levels that I form are usually on the monthly time frame. So they're all very hard levels. Thus, you're able to play them upside and downside. So hopefully that helps. And regarding your expiration for strike prices and whatnot, if you are intraday trading, so if you're scalping and or day trading, I would highly recommend staying on either the at the money or in the money strikes. If anything, maybe one strike out. Other than that, though, if you're not able to afford any of those, any three of those, that it's out of your wheelhouse, it's too expensive, find something else. There's always going to be other, stocks to trade. Absolutely. Now, if you're talking swing trades, you would want to buy a couple weeks expiration, at least 2 weeks of expiration, 100%. And then it's okay to go a couple strikes out if it makes sense. It can't be super, super far out of the money, but going like 1, 2, maybe even 3 strikes out, that's fine. So it really depends on the specific situation. But I hope that clears up your question. What else we have? Do you only watch this in one time frame? No, I usually watch a couple different time frames. So it really depends on what I'm trading. So usually I'll have at least two charts up. So like let's pretend I'm trading, I don't know, QQQ, and I would have my entry chart, which is usually I enter on the 2-minute because I'm more of a scalper slash day trader. So I usually like to enter on the 2-minute. And then I like to see at least some sort of confirmation on the 5-minute. And then once I'm actually in the trade, then I'll probably move this up to maybe 3-minute just so I'm able to monitor it and keep this on the 5-minute or maybe even switch to like the 10-minute. Because I'm only in intraday stuff, so I don't really care about like the hourly or like the 4-hour or anything like that, because I'm only in for a couple candles and I'm out, right? That's just how I like to trade. If you'd like to hold longer, perfectly cool. Just instead of sitting on the 10-minute, maybe just monitor on the 15-minute. It's entirely every trader is different. This is just what works for me. Hope that helps. One sec. So we have a trade review. One sec. We have Google. Let me look at that real quick. Okay. So Google $98 puts October 14th. Heavy sellers around 102.78. So let me just remark that. 102.78. Let's do 80. Okay, that's right there. Gotcha. The contract was cheap and had enough volume. I entered under 102.50. So let me just mark that as well. 102.50. Gotcha. And after it went through 102.60 support, it rejected it and it bounced back just inside if I saw it correctly. Yeah, absolutely. So this is this is where we saw initially. This is the right here, and this is the example of the retest. Right. So if you missed the initial impulse down, you didn't get in prematurely, like somewhere right here, and you missed the initial impulse, that's the example of the retest. Back testing and retesting the initial impulse zone. Yeah, absolutely. Congrats. Good job. All right. So could you please explain how you identify areas of liquidity again? So I usually use a platform called Bookmap that basically just shows me the liquidity, but you can kind of eyeball it as well if you do not have access to that. Perfectly cool. PS, if you do use Thinkorswim, they do have a free version. Just contact the support and be like, hey, mister, can I please check out your free version of Bookmap, and then they'll happily put it on your platform. Just kind of an FYI. But anyway, you can kind of see here. Let's do like the hourly, for example. So I can almost 1000% guarantee you there will be some sort of participants willing to step up here, because this is the $100 level. This is a psychological level. This area once was a resistance, now acting as a support. This is an example of a liquidity area. So then up here, 104, I had this level marked as a monthly level. I can almost guarantee you there's going to be some sort of area right here once we come back, because if you look, there is participants willing to step up there. So that's another example of what liquidity means. Basically, we're a generalized area of people that are sitting at. So like it has to, let's pretend we see nothing else, nothing at all, and just like don't even look at the numbers, just visually, this is the example. If you only see like this with like no participants in this area, that's not really a lot of liquidity. So that's just kind of nothing at the moment, but we want to see, multiple tests within that general area. That is an example of what a liquidity area is. Hope that helps. What is your favorite setup to take a trade? At a key area, psychological number, I would like to see a retest. So if it breaks out of a high, I would like to see that high get retested, and I'd like to enter there. If it breaks below a low of day, I'd like to see that area get retested, and I would enter shorts there. Also, I like to enter on key value areas, such as a point of control, VWAP, 200-day moving average, or 300-day moving average. That's usually where I like to become a participant for most of my trades. I like the fair value areas, and I like fading trades. So I like being more of a counter trader. It works for people. Sometimes it doesn't work for others. Everyone's different, but that's why I like to trade. Do you use okay, that's a good question. Do you use a stop loss at the same time as placing the trade? How often do you use a stop loss? I mean, you should know generally where your, how do I put it? You should know where your invalidation zone is before even entering a specific trade. Like before you even enter a trade, you should be like, okay, if this is correct, here's a couple targets for the upside, or just in general, here's a couple targets where I'm able to take profit. Maybe have 3 in the back of your head, just, plot it out. Or be like, okay, here is where I'm invalidated. It could be a max pain threshold. So like if you're comfortable losing $100, put it at $100, right? Or if it's under a key area, so like if it's no longer making a higher high, higher low, if it broke structure, you're getting invalidated. There you go. If it broke below or above a very key area, that's another possible invalidation, right? So there's not just one cut and dry answer of stop losses. It's just there's multiple different ways of how to be invalidated. But usually I don't use hard stop losses. I use mental stop losses. Yeah, hope that helps. Okay, we got another trade view. One sec, let's check that out real quick. Okay, so entered SPY puts at 11:40. Oh geez, I should have asked if this was Eastern time or not. I'm just gonna hope it's Eastern time. Let me see. 11:40. That would make sense if it was. Let's just hope it is. Exit at 11:50. Well, let me read the rest. Thesis was we closed on a 5-minute candle underneath the 9 EMA, and we couldn't go above 370. Yeah, okay, that makes sense. Okay, yeah, that makes sense. Okay. So if this is indeed Eastern, was this a loss for you? I should probably go look at the chat. Yeah, I'm gonna go look. One sec. Let me scroll down. Okay, it is a loss. All right. Yeah. Okay, so let me just scroll back up to read the question. 1 second. Sorry about that. All right, so let's just kind of review this really quickly. So this is another thing I'm saying about like stop run hunts, right? So a lot of people got stopped out right here because they thought, okay, we're gonna break 377, blah 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 blah. This is them being proactive. We didn't hold at all over 377. We kind of peekabooed really quickly and then just dropped hardcore. So this is where a lot of people get trapped out at, or or just kind of take losses because they get a fake out, right? So also you kind of entered puts, which I understand why you did, but you kind of entered puts at a lower, excuse me, a higher low. If anything, a put entry would have been a little bit more valid somewhere up here, right? A little bit higher once you saw this lower high. right? You don't want to be chasing right here because then you're paying more money and you're also remember we talked about that your risk to reward is a little bit skewed because technically your risk is way up here. You risk $1.50, which is if you entered somewhere over here, you only risk about like 50 cents. Yeah, like 50 cents or so, right? So hope that helps. And for stop losses, do you look at a percentage or the stock price? Usually anywhere from 7 to 30%. Depends on the specific criteria. If I entered well, clearly my stop loss is going to be tighter. If I didn't really enter that great, then I just have to understand that it's okay as long as my thesis is still valid. Then I'm just gotta be okay with keeping my stop loss a little bit wider. Therefore, that's why I have a generalized range, anywhere from 7 to 30%, for day trading, by the way, not for swing trading or anything like that. But yeah, so I don't like it to keep a generalized stop loss. Having like a generalized 20% stop loss isn't really helpful, because most people will tell you, hey, just put a 20% stop loss. Every single person knows that. Like literally everyone knows that. Market makers know that. Hedge funds know that. Other retail traders know that. You're not savvy because you're using a 20% stop loss. That's probably why you're getting stop hunted out a lot, because that's where everyone else is sitting at 20%. That's the majority of liquidity is sitting there. Therefore, it's getting hit and pinged out and transacted. Hope that helps. What chart platform are you posting that shows red and green snake behind candles? That's the Bookmap platform. Is liquidity areas usually near demand and supply zones? It also sounds like higher volume areas using the volume profile indicator, if I understand correctly. Absolutely, 100%. Congrats. You are the best. Yes, that is perfectly. Will this recording be posted? Absolutely. Are you bullish or bearish tomorrow? Not sure until pre-market. Oh, Jesus, this is a long one. Hey, Scrub, I really love the way you explain things clearly with trading strategies and such. Is there any way I can ask you more questions specific to my trading? I'd love to learn more from you. You're a fantastic teacher. Well, sir, you are very kind. I appreciate that very much. Yes, sure. Just message me privately. We can talk about it. But that actually kind of brings up another point. I've had a decent bit of inquiries lately because people have been really finding value with this question and answer type of type type of teaching that I've been doing, the question and answers. So decent bit of inquiries about it. So I thought about possibly still on the fence about it, but if you're interested, something I'm thinking about is maybe hosting like a something 2 weeks, maybe do about like 10 hours together, and we can just do more kind of on a group basis, like a smaller group basis, and then just really kind of just hone in on questions, like more direct questions, more trading reviews and everything like that. So this way we can kind of pick apart what you're struggling with and really kind of accelerate your trading journey. And this way it can really help people more individually. Honestly, I'd probably put it really affordable price, if anything, just to help people out. So if you're ever, if you're curious about that, I'm still on the fence about it, but if I get enough participants that are willing, maybe we can do something like that in like 2 weeks. So just message me privately on Telegram or Discord or something like that, and that'd be fun. I think that'd be pretty helpful for people that are wanting a little bit more personalized questions. Just well, just message me privately, and we can talk about it. But regardless, I really, really appreciate that. That's very nice compliment. Thank you so much. What else we have? That is a tough one. You can easily say that's a bull flag waiting for a breakout. So I'm assuming we're talking about this one. Yes, it very well could be, right? But oops, let me get out of this. But where do we go? It technically is, because we are consolidating, but we have to realize that the trend lines, people rely on trend lines way too often. And yes, they matter. Like we said before, yes, they matter. But what matters more is the actual liquidity, because the price action will inherently be a magnet to wherever the most amount of liquidity is. And it will pick up that liquidity in order to have another leg higher or lower. So that's super important to know. So I wouldn't really necessarily rely on trend lines as much, because people use them as crutches, because this is a prime example of it not working out at first, but it actually working out later. So most technical analysis traders would have 100% got stopped out there, because most times it's like the rule of thumb is, okay, it broke under the structure, let me get out. Yes, but it actually worked out because this was just a stop run hunt. Stop run hunts happen very often. Pros and cons of TradingView versus Thinkorswim. Good question. Honestly, I really enjoy TradingView just for the simplicity, and it's very efficient to chart. Thinkorswim is perfectly fine as well with the chart, but it's a little bit more clunky. That's just my personal opinion. Either one is perfectly fine. Absolutely. It's really just personal preference. Do you use Fibonacci's? Yes, I do. What about for long-term holds? How much of a stop loss should you set? I mean, it really depends on the specific asset that you're holding and how long you're deciding to hold. Like if it's a shorter term hold, like under like 6 months or something, maybe like 50%. If you're holding for a couple of years and you don't give a shit, you could literally do like 60 or 70% if you really don't care. Like if you truly plan on holding for like 5 years, and you know that the stock is strong and has held well during past recessions, then you really don't care. Just average down and DCA, so dollar cost average. Candle closes are very important. Yes. Understanding candle closes and timestamps when you enter is very, very important. And also understanding how they plot. So like if I'm bullish and I see another candle plot up here, I'm good to go. I'm not exiting my trade just yet. If I keep seeing this over, one plotting above another, that's perfect. This is what I want to see. But the moment I start seeing something like this, if I'm bullish and I start seeing like maybe a plot below, that's not really what I want to see, right? So this could be a sign of a possible retracement. Or if you see something in the middle, sounding like a neutral candle, this is pretty much saying one of two things. Option one is, okay, we're making a new support here. We had a momentary stall out. We're making a new support to go higher. That's option one. Option two is, okay, we had a momentary stall out, and this is actually the short-term top, and we could very well retrace. So how candles plot are very important. So just kind of be mindful of that. Which indicators do I use again? Yeah, absolutely. I use 200 exponential, 300 exponential, VWAP. And I also use a volume profile, which is called SVP. It looks like this, like that. That's all I use. I'll just leave it up here for people that want to check it out. Could you talk about gaps and how to trade them? Yeah, absolutely. Let me find a gap real quick. Okay. All right, there we go. I'll just use, actually, hold on. This is more recent. We'll do this one. Okay. So let's just pretend this didn't happen. Actually, it didn't happen on SPY. So we'll do that one. That's it. Yeah, there we go. So since this is not filled just yet, this happened in the overnight session. This is a gap that filled, or excuse me, that formed in the overnight session on ES, right? But it portrayed and showed on the SPY ETF. This is a gap. So gaps are basically just imbalances into the market. And when we have imbalances into the market, what happens is the stock market doesn't really like having imbalances. So what happens is Let's pretend this ends up breaking lower, which it very well could. So if we break below like this 371, the next real target wouldn't be until this high a day, so 368.60, and then the actual gap fill. Well, we would have 370 first. 370 is a psychological whole number, so we would have the major target would be the gap fill, and then we would have kind of minor targets along the way. So that's pretty much just how you trade gaps. Now, also, where's another? I know we had another gap here. So I called this one out in the chat as well for everyone. So this is an example of what is known as a gap and crap. This is something you want to be super aware of. So if you ever see a market gap up significantly like this, we need, and I repeat, we need to see a follow through pretty much within like the first 15 minutes. If we do not see a follow through, that means the bulls are not in control. And what happens, usually something like this. We had a false breakout, basically picking up that overhead liquidity. The bulls were not strong enough and we crapped. And the gap fill was the first major target. Look what happened right when we got to the gap fill. We had a stalling out period because that was a target. And then we kept on going lower, right? So this is an example that happens very, very often. If you see a gap up, you need to see a follow through in the morning. If you don't see one within usually the first 15 or so minutes, and it's very weak, there's no follow through, your first real target is that gap fill. This works exactly the same for gap downs, right? So let's just say it gaps down and there's no follow through, their bears are not strong, you already know your target. That gap fill. So hope that helps with gaps and gives you a little bit more insight. What would you oh, that's a good question. What would you recommend new traders focus on first to better their trading? Oh, okay. Well, this is a loaded question, so let's do it in a couple different steps. So just to reiterate for people that didn't hear it, what would you recommend new traders focus on first to better their trading? First, understand that this is not a get rich quick scheme. Contrary to popular belief, if you are new, you're not going to make 50 grand in a week, especially if you're on a $1,000 account. If you think that, you are delusional. Okay, this is not a get rich quick scheme. This is a long journey, and that's okay, right? You have to think about it in the long term run. You might not be making that much money now, but if you stay the course, you put the work in, 6 months later, 12 months later, 2 years later, you will start making a good bit of money, right? That's the one beautiful part about trading. This job and commission-based jobs are the only job in the entire world that has zero salary cap, like literally zero salary cap. It's not far-fetched for you to make $100,000 in 1 week. It's not far-fetched for you to make $500,000 in a month. Now, obviously, it's going to take you time to get to that level, but that's the beautiful part about trading is it's a constant challenge. Like it's the way I think about it is it's a video game. So everyone starts on level 1. We're all fresh level 1s, no gear, no stats. And once we start building these building blocks of fundamentals and we start getting the skills and we start honing in on what our strategies are and what works for us and reeling in our psychological barriers and mastering our psychological barriers, we start leveling up and leveling up and leveling up. It's all a stepping stone process. Most of the time people are thinking the end. They're thinking about level 99 already, but they're skipping a step going from 1 to 99. You don't want to do that. You want to go from 1, 2 to 3, 4, keep going all the way up to 99. Because if you just try to go out the gate 1 to 99, more times than not, you're going to blow your account. Yeah, sure, you might make a couple racks, but if you have no idea what the hell you're doing, I can almost guarantee you will lose that money. Like I can name you 50 people off the top of my head in the last 6 months that has told me, hey, I made 20 grand. Hey, I made 50 grand. Hey, I did this, this, and this. I reach back to them, reach back out a month later. Guess where those people are? Right back to square one because they don't know what to do, right? This is the important part. So for new traders, something that I unfortunately did not do myself. I was very stubborn. I'm very arrogant. I had a lot of ego. So like the first like 6 to 9 months of my trading career, I was super stubborn, and I tried to do everything by myself. And what happened was I just kept taking loss after loss after loss. And then once I was like, okay, let me put my ego aside, let me just suck it up. And I start seeking other people that are ahead of me, right? They've already done this process. So I was like, okay, maybe if I start seeking out education or some sort of mentor, some, anything. By the way, that has to be from a reputable person, not just some random person you met on Instagram. But anyway, so seek out someone that knows what they're doing, that's already been in your shoes, so they can be like, hey, bud, I've already done this. I've already, everything you're facing are at the moment, I've already done. Like I failed whatever you're trying to do 30 times. So let me help you and accelerate your journey by saying, hey, bud, don't go this way. Go this way instead. Do this instead of this, right? So this way, you exponentially help your trading career. So instead of struggling for an entire year, maybe you're only struggling for 6 months or 3 months, right? So, and also something else is you have to actually be willing to put the work in. Like the mentor can tell you exactly what to do, but if you're not going to listen and you're not going to like actually, put some work in, it's not going to help you. Like you actually have to be willing to put some sort of work in. You can't just wake up every day 5 minutes before market open and expect to make $1,000. Like you have to at least put some sort of work in, some sort of screen time in, some sort of research in, consistency, discipline. And what happens is the end result is profits. Don't think about the profits first. Think about, okay, how can I build a good foundation? What are the steps I can do to figure out my consistency? And then just kind of go from there. Be like, okay, what am I good at? Am I good at scalping? Am I good at day trading? Am I good at swing trading? Am I good at spread trading? What am I good at? Everyone's different. I could be god awful at swing trading. You could be fantastic at swing trading. Everyone is different. So figure out what is good for you niche wise, and then kind of just go from there and just do stepping stone by stepping stone by stepping stone. So once you build that good foundation, then you think about the profits. Then you think about more efficiency. Be like, okay, how can I scale up? How can I make more money next time? How can I be more efficient with my entries? How can I be more efficient with my exits? And that comes from trade reviews. That comes from back testing. That comes from better screen time. That's all these different things that you have to end up doing. You have to understand market rotations. You have to understand flow analysis. You have to understand how the actual market moves, supply and demand. You have to understand, especially if you're an option trader, what the hell an option contract even is, how an option contract is formulated. Like what is a delta? What is a gamma? What is a vega? Sometimes new traders have no idea what the heck that even is, and they're purchasing it. They don't even know what they're purchasing, right? So like these are the things that you want to be thinking of before actually thinking about the money. Consistency first, money second. Is not the other way around. Most of the times people are just thinking money, 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 money. And usually, yes, they might get some money, but then they blow it a little bit later. So it's 1 step forward and 3 steps back. Right. So if this is resonating with you, this is a wake-up call to figure out what you are doing incorrectly. And instead of just like, okay, I just took a loss, let me close my computer. No. Okay, I just took a loss. What did I do incorrectly? How can I improve? What am I doing at the current moment? So this is actually something important. Ask yourself over the last, say, 3 months, what is the most important thing that I've been doing inconsistently wise over 3 months? What is my biggest issue? That issue is something you need to face and address immediately, or you're not going to do anything. You're just going to keep plateauing. So let me kind of give you a couple different issues. Let's say, okay, over the last 3 months, I'll give a personal example. This is a personal example that I found out myself. So when I was back testing and doing my journaling, I realized over these last couple months, I was losing primarily in the second half of the day. And I was like, okay, what's going on? Why am I losing in the second half of the day? What's going on? And if I didn't have this data, if I didn't actually take the time to write this data and write my trade reviews, I wouldn't have known. So I found out after doing some research and digging deeper, it looks like every single one of my losses in the second half of the day comes from 0 DTE, right? I was taking 0 DTE trades and most of those losses were for them. So what do you think I did? I stopped trading 0 DTE after lunchtime. That's the biggest and simplest fix ever. Just not trading 0 DTE after lunchtime. And what do you think happened? I don't take as many losses in the second half of the day anymore. Okay. So like if you didn't understand and have that data, how are you going to know that's the reason why you're taking these losses? So that's one example. So another example is, okay, maybe over these last 3 months, I've had my biggest issue was stop losses. I have such big tendencies to not adhere to my stop loss. I just, I have that hopium. I'm just like, okay, it's going to bounce. It's going to bounce. It's going to bounce. And I just keep putting my stop loss lower and lower and lower. And maybe my 20% stop loss turns into 50%. If that's your issue, if that's resonating with you, that's something we need to address immediately, or you're going to keep plateauing. Okay, another issue, let's say FOMO, right? Let's say for example, like we talked about the FOMO. Let's say I miss this entire drop, I'm trying to chase puts here, right? This is FOMO. If you're experiencing FOMO a lot, that's your major issue that we need to address immediately. Then we go one step deeper and be like, okay, how can I combat this issue? What are the steps I can take to combat this, right? So then you just go one step deeper and develop a specific plan for yourself to combat that issue. And you just kind of keep repeating that process and repeating that process. Okay, what's my second largest issue? What are the steps I can take? What is my third largest issue? What are the steps I can take? And you just keep going down the run. And if you just keep doing this for months and months and months, guess where you're going to be at? You're going to be exponentially better. So instead, for the next time you take a loss or something like that, don't just be angry and close your computer. Be like, no. What did I do incorrectly? How can I improve? Okay, these are the things you want to think about before even thinking about profits. Consistency first, fundamentals first, profits second. Also, literally just please seek some sort of education because it'll help you so much. Don't be me. Don't be stubborn for a year and then seek education. Really just do it and it'll pay off very quickly. Like even if you pay, let's say $2,000, $3,000, that might seem like a lot up front, but it's literally saving you 6 months of time. And now that you actually know what the hell you're doing, you can make that $2,000 back pretty quickly, right? So hope that helps. Don't think about the money. Consistency first, fundamentals first, money second. Definitely got off topic there. So I'm going to do a couple questions here and I'm going to end the session. So hold on, let me just scroll down real quick. Do you play World of Warcraft? You're damn right I do. For the Horde. How old am I? I'm 26. It would be great if you do one of those small group things you were talking about for beginners. Absolutely, just message me privately. I'm sure I'll set something up for you guys as long as there's enough people. I'll do something in like 2 weeks, something like that, 1 or 2 weeks. And so just message me privately. We'll set it up. We'll talk about a lot of stuff. We'll get some good information in, review your trades, all that fun stuff. Hope that helps. How many accounts did you blow? Probably like 10. Because remember, I was really stubborn in my first year of trading. So I just kept trying to do everything by myself. That's why I kept blowing so many accounts. So save yourself the trouble, save yourself some time, save yourself some money, and just invest in someone that actually knows what they're doing. Not even myself, like literally anyone. Like as long as they are actually profitable and knowledgeable, they can help you, right? They can help you. Yes, that's a great analogy. You are an engineer. Piece by piece, build yourself to be the version of an ideal trader. Just like a car needs a frame, wheels, and engine. Yes. Yupper doodle, yupper doodle. Did you go to college? I am a college dropout, baby. I was nursing beforehand. A lot of people are asking me about my information. 1 second, let me drop some information for you guys. Here is my information. If you would like to chat, we can chat questions, we can chat mentorship stuff, we can chat trade reviews. Always happy to help a fellow trader. How much money oh geez, how much money did you lose and you kept going? Probably like 10 grand, give or take, over the course of about a year-ish. Now that might not seem like a lot to you, but at the time that was a lot of money to me. Like I was basically like broke at the time. So yeah, that to me at the moment, that was a lot of money. But anyway, if you guys have any other questions, I'll answer like 1 or 2 more questions and then I'm gonna head out. Hope you guys learned some cool stuff from this one. I thought this was a pretty good session. Yeah, this is a good session. My name is not Brett, my name is Scrub. Live trading. Usually I don't really enjoy live trading. I mean, I don't mind it. I don't really mind it. It just, okay, the reason, because a lot of people ask me that, so the reason I do not enjoy it is because it creates false expectations. So if people come on and watch me live trade, they basically assume that I'm going to take a trade. They assume and they want me to take a trade. That leads me to have, that gives them a false expectation because not every day is a trading day. And I'm not just going to, force a trade just to appeal to you, because my trading comes before your trading every single time, right? So just because there's not, it's not a trade right now, most of the times people on live trading expect me to take a trade, and that's not going to happen. I'm not going to suffer my trading account for your expectation. I've tried live trading before at the beginning of the year, and that was what happened. A lot of people are like, bro, why are you not taking trades? Why are you not taking trades? Because there's no goddamn trades, bro. Like, I'm not about to just jump into a trade just to jump into a trade. I will wait for my setup. If my setup is not there, I won't trade. Like, there's some days where I will not trade the entire day. There are some weeks where I will not trade the entire week. The entire week. I don't give a shit. If my setup is not there, I won't take it. Period. And I'm not going to just force a trade just because you want to take a trade. So that is why I don't like to live trade. There's a lot of expectations on me. There's a lot of pressure. I do not enjoy it. I usually suffer because of it, because I feel like I'm obligated to take a trade. And that is not, I'm not going to do that, because then I suffer. Like my account in January, when I tried this, I lost a decent bit of money because I was trying to appeal to others and, take trades when the trades were not there. And that is the reason why I don't like live trading. So yeah, I don't mind posting like recordings of myself, because most of the time I do like record myself trade and I kind of do commentary just for myself. Like I kind of just back test and review what I saw, honestly. So I don't really mind posting that type of stuff and just showcasing the education behind it, because it's still valuable. And this way you don't have to sit through like 2 hours worth of just nothing. I chop it down so you only see that trading segment. So this way it's, everyone's still getting value and I'm not getting pressure to take a trade. So yeah, that's kind of just the reason why I don't like live trading. I don't mind it. I just don't enjoy the expectations of having to take a trade when there's no trade there. But anyway, definitely a great session, guys. I appreciate every single one of you for staying. Hope you learned some cool stuff. I dropped my information in the chat if you want to talk to me, any questions, trade reviews, anything. I'm always happy to help a fellow trader. I had a couple people ask me about that group thing we talked about. Just message me privately. We can start something up in maybe like a week or two. We'll iron out the details.
it'll probably be about like a 2-week session or so. So just message me if you're curious. It's probably I'm going to make it very, very affordable so everyone can, I really want to give a lot of value for a very affordable price. So if you're curious, just reach out to me. I'm going to have a probably limited spot. So this way I'm able to actually like cater to different trade reviews and just kind of, answer specific questions so it can help everyone. So if you're curious, just message me. There's my information. But I appreciate you all so much. Hope you enjoy the rest of your night. You sleep well, and toodle. What is your question, Steve? What you got? I'll do one more. Can you talk about the buy sell volume? Yes, it's as you can kind of see here, it's whatever time frame it is in. It is showcasing within that specific time frame who is in control. In this case, in this 15-minute time frame, the bears are mostly in control because the red was higher than the green. So it's basically more red is more bearish, more green is more bullish. So I hope that helps. One more time, here's my information. If you want to talk, always happy to help. Enjoy the rest of your night. Sleep tight. See you guys tomorrow.